Holy smokes, everyone. It is happening. It is time to wake up right now. House prices are dropping at their fastest pace in 39 years. Yes, that's right. It is worse than 2008. It is worse than the Great Recession in the 1990s. And in today's video, I'm going to be going over the Australian housing market. But guess what? Everyone around the world needs to watch this video, whether you're from the US or Europe, because this is going to be a global housing market crash because of what happened in 2020. It was the same across the world. They lowered interest rates, they printed the money, and now we're starting to face the consequences with record high inflation. So for all my Australian viewers, you have been asking for Australian housing market update, so I'm going to give it to you now. So let's not waste any time. We've got huge news, huge data that shows that the housing crash is happening now. So we're going to go over why is it happening, will it get worse, and how much could prices fall. Okay, everyone, let's get into it. Okay, so first things first, I think we all know property is a bit like a religion here in Australia. Everyone trusts in property. Everyone knows that property prices only go up. They can never fall. If they do fall, they'll rebound the next month, the next year. The government will never let the housing market fall. We have a generation that thinks property prices only go up and they can't fall. Well, they're about to be dealt a very strong reality check. Let's go over why we've only seen house prices go up for the past 30 years. Well, this is why, everyone. This is the RBA's cash rate. This is the interest rate the Reserve Bank of Australia sets, and other banks have to borrow at this rate, and then they charge you interest on top. Now, this is the reason why house prices have seemed like they've only gone up over the past 30 years. This is because since January 23rd, 1990, interest rates were at 17.5%. That's right, everyone. Once upon a time, interest rates were 17%. And comment down below if you remember these times. Now again, what happened since then, the recession we had to have? They dropped interest rates all the way from 17% down to 4%. And then every single crisis we've had since then, they've been able to drop interest rates lower and lower. For example, in 2008, they dropped interest rates from 7.25% all the way down to 3%. But you can see here, they've been running out of ammunition every single recession. And since April or June 2019, they dropped the cash rate from around 1.5% all the way down to 0.1%. And I'm sure what you all know is the housing market relies on debt. And it's because debt has been getting cheaper and cheaper. People have been earning more money. They've been able to bid up house prices to make them more and more expensive. But in 2020, the Reserve Bank of Australia used their last few shots of ammo and they dropped interest rates to 0. So that only means interest rates can only go up from here. And that is what they're doing. And something us Australians need to know is, even if the Reserve Bank of Australia doesn't want to lift interest rates, well, if the Federal Reserve, the US central bank, and central banks around the world are lifting interest rates, they have no choice to follow. And this is what we saw happen. Remember, the Reserve Bank of Australia said, don't worry, take on debt in 2020. Interest rates won't go up until at least 2024. Well, they had to change their tune very, very quickly when inflation started to get out of control and when the Federal Reserve started to hike interest rates by 0.75% every month. And the Federal Reserve is going to likely have to lift interest rates to 4%. So the RBA is saying, don't worry, we're only going to lift interest rates to 2.5 or 2.75%. No, people, they're going to have to go much, much higher than that, because if they don't keep up with what central banks are doing around the world, the currency is going to drop lower and lower. And that's what we've seen. We're seeing the Aussie dollar drop from around 80 cents to 68 cents. And if the currency keeps dropping lower, that makes inflation worse because that makes imports more and more expensive. So this is just the beginning. The Reserve Bank has only just started to lift interest rates, and it's going to take time for the market to reprice these high interest costs. Just interest rates going up that is spooking the housing market is also builders. We're seeing building companies starting to collapse at a pace we've never seen before, and they're dropping like flies. Listen to this. Oracle Liquidator issues dire warning over relentless cycle which could see more construction companies collapse. And I don't know if you heard some of your friends or family say they've gone, for example, into a contract to build their home only for the builder to try to get out of the contract or tell them they're going to have to pay another $50,000 to go ahead with the build. And we're seeing in many cases, it is an extra $85,000 to build a home compared to what it was in 2020. Look at this, Australia's debt to GDP. It is some of the highest in the world at 190%. And you know what happens with debt? Eventually people's borrowed capacity gets maxed out. So we're getting to a point where consumers aren't going to be able to afford to take on much more debt compared to other countries that have a much lower debt to GDP figure. And also this, Australian wages rise just 2.6% in June, but they continue to lag inflation. So this has been the story for the past 20 years. Australian standard of living has continued to fall lower and lower and lower. And even though people are getting a pay rise, it's not keeping up with the rising cost of living. So again, when they go to get a mortgage, they're not going to be able to afford to borrow as much as they used to. And the reason why this time is different compared to other downturns, they were able to drop interest rates and they were able to reverse course once house prices started to fall. But with inflation at 6.1% and it's only going to get higher, the government and the Reserve Bank of Australia isn't going to be able to inject huge amounts of stimulus like they could in 2020, and they're not going to be able to drop interest rates once we enter in a recession like 2020 as well. So okay, why you're here and what you wanting to know is how much did house prices fall, what areas are falling the most, what areas may be rising, and how bad will it get? Let's have a deeper look, everyone. So look at this, house price plunge spreads with the biggest monthly decline in 39 years. CoreLogic Home Value Index slumped 1.6% in August. This is the biggest national monthly decline since 1983. And again, remember, the Reserve Bank of Australia has only just started to lift interest rates. We're not even at the peak of what interest rates are going to be. So I expect things are only going to get worse. So okay, where were the biggest falls? So the biggest falls continue to be in Sydney, where prices dropped 2.3% last month, while Brisbane dropped 1.8%, Hobart 1.7%, and Canberra dropped 1.7%. So what you have to know about the Australian housing market is it's not just one market. So when I talk about declines or what's happening in the Australian market, you have to do your research for your state, and not only your state, your city and your area of the city. Because even in, for example, Melbourne, there's the east side, the west side, north, south, and even in the suburb you want to buy, there is a better part of the suburb, there's a worse part of the suburb. So really have to get down granular to figure out what's happening in your market. But we can see here Sydney with the biggest drop, 2.3%. And what are we seeing? We're seeing a lot of people leaving Sydney for the Gold Coast. We're seeing a lot of people move to cheaper states because it is so unaffordable and it's not really worth living there anymore. And normally what happens with the housing market in general is the upper end of the market, the most expensive areas in the housing market, they tend to drop first and drop the hardest, but they are also the first to recover. And we're also seeing here Brisbane coming in second with the biggest decline of down 1.8%. And what did we see in 2020, 2021? We saw huge interstate migration to Brisbane and the Gold Coast, etc. But with prices going so crazy high in Brisbane, we're starting to see the housing market correcting. Prices were just down 0.2% in Perth and down 0.1% in Adelaide, and Melbourne recorded a further decline of 1.2%. So areas like Perth and Adelaide that are much more affordable, we're not seeing prices go so crazy in those areas. Now, what was another big area of the Australian housing market that saw huge growth was regional Australia. And we are starting to see house prices in regional Australia begin to fall as well. So regional areas have also begun to slide quite steeply, with CoreLogic recording a 1.5% fall outside the capitals. And maybe what we're seeing here is a lot of people that moved to the regional areas in 2020, maybe they're thinking the commute is too far now, or maybe simply their work is telling them have to come back into the office. So maybe we're starting to see some more migration back to the capital cities, or simply the locals in these areas can't afford these prices. So now these regional areas are starting to correct as well. So according to CoreLogic, Sydney has seen the biggest recent decline from its COVID peak off 7.4% since January 2020, with Melbourne down 4.6%. So again, you may think, look, this is not that much. It's not that much of a decline. But again, this is only the beginning. With prices dropping 2.3% every month, we could see price falls of up to 30%. Listen to this, risk of a 30% price crash. AMP Capital Chief Economist Shane Oliver believes that this decline may mark the end of the quarter of a century house price boom. And this is what I was talking about, people. We're seeing interest rates only go lower and lower and lower over the past 30 years, and this is now going to come to an end. We're now going into a very inflationary time like the 70s and 80s, where interest rates went all the way up to 17%. This cycle may be different both in terms of being deeper and taking longer to recover, thanks to a combination of high household debt levels, high home price to income levels, and an end in long-term downtrend in interest rates. Just like what I was showing you with our debt to GDP, household debt is so high, people simply can't afford to borrow much anymore. Increased listings in the spring selling season will likely add to pressure on house prices, and a surge in fixed rate loan expires next year risks driving a sharp rise in distress selling as up to a quarter of home borrowers roll over into much higher mortgage rates, which will further add to downward pressure on prices, he noted. And I completely agree. We saw huge amounts of people fix their interest rates at 2% in 2020 when interest rates would drop massively, and this is going to expire. At the same time, remember this debt bomb of interest-only loans. Looks like people have forgotten about that, but eventually people are going to have to switch back to principal and interest. So I think we're going to see, a big issue of people going from 2% mortgage rates to 4 or 5% variable interest rates from these fixed rate loans. And we're also going to see a massive amount of people switch from interest only to interest and principal. And this will happen at the same time when utility bills are skyrocketing. I got my water bill and gas bill. They are getting much, much more expensive. We're seeing groceries rise. Simply people aren't going to be able to afford this huge cost of living shock. So what are they saying is the biggest risk for the housing market of all? The main downside risk to our forecasts would be if the cash rate is raised to the 4% level. The money market is assuming this would more than double household interest payments and push total mortgage repayments to record highs relative to incomes, and likely drive a 30% or so fall in prices. And while people are saying no, this is impossible, it'll never happen, again, how is the RBA going to stop 7-8% CPI inflation when we all know it's more like 15%? How are they going to stop that with an interest rate of 2.5%? Normally what central bankers have had to do throughout history to stop inflation is to either lift interest rates up to match inflation, or in most cases had to lift interest rates higher than the inflation rate. And I don't think we can believe them when they say, don't worry, interest rates will only go up to 2.53%, because they said the same thing about interest rates not going up till 2024. So like we couldn't believe them back then, we can't believe them now when they say interest rates will only go up to 2.5 or 3%. So everyone, I know what you're thinking, okay, what does all this economic jargon and data mean for you in simple terms? What this means simply is, normally for every 1% increase in interest rates, we see people's borrowing capacity, and therefore house prices normally fall anywhere between 8 and 10%. So if the RBA has to lift interest rates up to 4%, we could easily see house prices fall 30%. Now remember, we have so many other risks happening right now. We have so many other pressures happening to the housing market, like fixed interest rate loans going to be increased by 2 or 3% when people go back to variable interest rate loans, interest only loans going back to interest and principal, and a rising cost of living and higher council rates is going to force many families to have to sell. But everyone, what do you think? Do you agree with AMP chief economist that house prices could fall 30%? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.